While you were celebrating the holidays, two things happened that nobody connected. And when you see how they fit together, you'll understand why the smartest money on the planet is moving faster than it has in 75 years. December 15th, 2025. Behind closed doors. No press conference, no headlines. The United States Department of Defense signed a deal that changes everything. $7.4 billion, not a loan, not a grant, an equity purchase. The Pentagon just became a 40% owner of the first major metal smelter built on American soil since the 1970s. Let that sink in for a second. The military doesn't invest. The military doesn't take equity stakes in private companies. The military buys weapons and deploys soldiers. But on December 15th, they became business partners with Korea Zinc to build a massive critical minerals processing facility in Clarksville, Tennessee. Why now? Why Tennessee? Why $7.4 billion? Because they looked at their stockpiles and panicked. This facility processes 1.1 million tons of raw material annually, 13 specific metals. 11 of them are on the critical minerals list. Silver sits at the top, not gold, silver. The metal that goes into Tomahawk missiles, F-35 fighter jets, and next-generation satellites. The metal you cannot print. The metal China just banned from export. January 1st, 2026, China's export ban goes live. Gallium, germanium, antimony, and the processing technology for dozens of critical minerals. No exceptions, no negotiations. The door slammed shut. And if you think that was coincidence, if you think the Pentagon signed their deal 2 weeks before China's ban by accident, you're not paying attention. The United States government knew. They moved first. They secured supply in December because they knew the price would explode in January. And it did. January 5th, 2026, Shanghai Futures Exchange. Silver hits 18,420 yuan per kilogram. You convert that to dollars, adjust for weight, and you get $82 per ounce. Not 75, not 76, $82. Meanwhile, New York is showing $75. Same metal, same planet, same moment in time, $7 difference. In high-frequency trading, people kill each other over 1 penny spreads. A $7 gap isn't an anomaly. It's a broken market. It's the sound of the global pricing system shattering in real time. Think about what that spread means. If you're a trader with silver in London, do you sell it in New York for $75? No, that's malpractice. You put it on a plane to Shanghai. You sell it for $82. You pocket the $7 arbitrage. Risk-free money. But here's the thing. That arbitrage should close instantly. Traders should flood the gap within seconds. The fact that it's not closing, the fact that it's widening, proves something terrifying. The metal can't move. It's stuck. It's encumbered. The Western vaults are empty, or the metal inside them is already claimed by someone else. This is what a supply shortage looks like when it goes from theory to reality. And the Pentagon saw it coming, which is why they didn't just place an order for silver. They bought the factory. They're not customers anymore. They're owners. The metal coming out of that smelter doesn't hit the open market. It goes straight into military stockpiles, removed from commercial supply before it's even refined. You want to know how serious this is? The Department of Defense is taking metal off the market 3 years before the facility even opens. That's not strategy. That's desperation dressed in a suit. But wait, because there's one more player in this deal that makes the whole thing absolutely surreal. The entity financing this massive Pentagon pivot is the same bank that spent 15 years manipulating silver prices downward, JP Morgan. The architect of the paper suppression scheme is now writing checks to build physical infrastructure. Let me be very clear about what's happening here. JP Morgan has been documented spoofing silver futures, massive short positions, rigging the COMEX. We've called them the enemy for over a decade, and we were right. But if you think they're stupid, you're making a fatal mistake. JP Morgan doesn't gamble. They're the house. And the house never bets on a losing position if they can avoid it. So when the biggest shorter of silver suddenly pours billions into financing a physical smelter in Tennessee, they're not doubling down on their manipulation. They're hedging against their own collapse. They see the same data we do. They see the deficits. They see Chinese solar demand consuming half the world's supply. They see the breakdown of the London bullion market. And they have realized that holding paper short contracts in a world of physical shortages is a suicide mission. If silver goes to $150, their paper shorts bankrupt them. But if they finance the smelter, if they control the facility that produces the metal, they're no longer the short seller. They become the gatekeeper. They're pivoting from betting against the price to owning the flow. This deal with Korea Zinc is their escape pod. While they're publishing research telling retail investors to exit the market, while they're telling the public that silver is overvalued at $75, they're quietly writing checks to build the infrastructure that will control supply for the next 30 years. Think about the psychology of that move. They're telling you to sell. They're buying the factory. They know the squeeze is real. They know that when the Shanghai price fully disconnects from the COMEX price, which is already happening with that massive spread, the paper market becomes irrelevant. The only thing that matters is who has the physical metal. And by the time this smelter comes online in 2029, JP Morgan intends to be the king of physical in the Western Hemisphere. Now here's where both crises merge into one. Same month, December 2025. While the Pentagon is securing silver supply, the United States national debt crosses $38 trillion. Not projected, not estimated, actual debt on the books. That's a $2.3 trillion increase in 11 months, the largest single-year increase outside of a world war. And while this is happening, quietly, without fanfare, foreign central banks are selling. China held over $1 trillion in U.S. treasuries in 2013. Today, $760 billion. They've dumped over $300 billion in the last decade. Public record. You can verify this yourself on Treasury Department websites. Japan, the largest foreign holder, reduced their position by $220 billion since 2022. Not all at once, systematically, month after month, selling into the market without causing panic. Saudi Arabia is selling. Belgium reduced holdings. Switzerland selling. France reducing exposure. The exodus is documented, verifiable, and accelerating. So who's buying U.S. debt now? Mostly the U.S. government itself, the Federal Reserve, government pension funds. They're printing money to buy their own debt. That's not a sign of strength. That's desperation trying to look normal. But it gets worse, because it's not just governments moving money. BlackRock, the world's largest asset manager, controlling over $10 trillion, has restructured portfolios, reduced U.S. Treasury exposure, increased positions in emerging markets, European infrastructure, Asian real estate, gold, commodities. They're diversifying away from concentrated dollar risk. JP Morgan restructured institutional allocations. Goldman Sachs reduced U.S. equity recommendations. Morgan Stanley increased international allocation guidance. Bridgewater Associates has been warning about dollar devaluation for years and positioned their funds accordingly. The smart money isn't waiting for headlines. They're not waiting for official announcements. They're reading balance sheets and moving capital internationally while the public is distracted by Bitcoin and tech stocks. And here's the connection nobody's making. The Pentagon smelter and the foreign treasury dumping are the same story. They're both responses to the same crisis. Loss of control. The United States can no longer control the price of strategic resources. They can no longer control global capital flows. Both systems are breaking simultaneously, and the timeline is identical. Pentagon signs the deal December 15th. China bans exports January 1st. Shanghai price explodes January 5th. Foreign selling accelerates December through January. Debt crosses $38 trillion, last December, all within 30 days. This isn't coincidence. This is coordinated panic at the institutional level, and the fracture point is becoming visible. There's been widespread discussion about the petrodollar system ending. Let me clarify what actually happened, because the truth is more important than sensational headlines. The 1974 U.S.-Saudi Joint Commission on Economic Cooperation expired in 2024. Fact-checkers confirmed there was never a formal written treaty requiring Saudi Arabia to price oil exclusively in dollars. It was an understanding, an informal arrangement. But here's what matters. Saudi Arabia has now indicated willingness to accept other currencies for oil transactions. They've explored yuan-denominated deals. They're diversifying payment systems. The practical effect is the same as a formal agreement ending. The dollar's exclusive grip on oil markets is loosening. When you combine that with China and Brazil trading in yuan, India and Russia settling in rupees, and over 40% of global GDP now in BRICS-aligned nations, building payment infrastructure that bypasses the dollar entirely, you're watching the reserve currency system fragment in real time. And this creates a devastating feedback loop. When global dollar demand drops, what happens to all those dollars sitting in foreign central banks? They come home. They flood the U.S. economy. That's when inflation doesn't just rise, it goes vertical. The Federal Reserve will face an impossible choice. Raise interest rates dramatically to crush inflation, which makes the $38 trillion debt completely unpayable and crashes the economy. Or keep printing, which destroys the currency through hyperinflation. Either path leads to the same place. And the institutions know it, which is why they're building lifeboats. The Pentagon is not building a smelter because they think silver will stay at $75. They're building it because they believe access to physical metal will be the defining competitive advantage of the next decade. They're preparing for a world where you can't just buy resources on the open market. You have to own the production. JP Morgan isn't financing this deal to make a few points on interest. They're repositioning from paper trader to physical gatekeeper because they know the era of financial engineering is ending. The era of resource control is beginning. And look at the timeline they're working with. Construction starts 2026. Facility operational 2029. That 3-year window tells you exactly when they expect the crisis to peak. But here's the critical question. What happens between now and 2029? What happens during those 3 years when the gap exists, but the dam isn't finished? The drain accelerates. Every day that $7 spread persists, more metal flows from west to east. Every month that foreign central banks sell treasuries, more capital leaves dollar-denominated assets. The pressure builds. The COMEX will have to raise prices to match Shanghai, or they'll be emptied completely. This is the catch-22 they're trapped in. They want to keep prices low to hide inflation. But if they keep prices low, they lose all the metal to China. If they want to keep the metal, they have to let the price rise. They've lost control. And this is where you come in. Because you're caught in the middle of two simultaneous collapses. Resource nationalism and currency debasement. The government is hoarding silver, foreign nations are dumping dollars, and you're sitting here wondering what any of this means for your savings, your retirement, your future. Let me make this very simple. When the most powerful military on earth and the most sophisticated bank on Wall Street both pivot to physical assets in the same month, you don't fade that signal. You follow it. Here's what you do immediately. First, understand that most of your wealth is probably in dollar-denominated assets. Stocks, bonds, cash, real estate priced in dollars. You're exposed. Not theoretically, actually exposed. When foreign central banks finish selling and those dollars come flooding home, your purchasing power evaporates. Diversification isn't optional anymore. It's survival. Consider assets that hold value during currency debasement. Gold has maintained purchasing power for 5,000 years. Silver is both a monetary metal and an industrial necessity. Commodities that can't be printed into existence by desperate central banks. Second, geographic diversification. If major institutions are moving capital internationally, consider following their lead. Not all your money, but some. Research stable foreign currencies. Swiss francs, Singapore dollars, Norwegian kroner. Spread your political risk across multiple jurisdictions. Don't keep everything in one system that's showing cracks. Third, understand the timeline. The Pentagon expects this smelter operational by 2029. That's their target date. It's January 2026 right now. You have roughly 36 months before they expect the resource war to peak. That's not years of comfortable planning. That's 3 years to position correctly. Fourth, increase liquidity. Keep accessible cash for opportunities. Yes, it loses value to inflation, but in a crisis, liquidity gives you options. The ability to buy crashed assets, the ability to move quickly when opportunities appear. Illiquid assets trap you exactly when you need mobility most. Fifth, reduce debt. High debt in a rising rate environment is financial suicide. Interest rates are structurally heading higher because the government needs to attract buyers for their debt. Every point rates rise makes your debt more expensive to service. If you're leveraged, deleverage now. And sixth, copy the trade the institutions are making. They're getting as close to physical assets as possible. They're bypassing paper contracts and going straight to the source. The Pentagon isn't buying silver futures. They're buying the smelter. JP Morgan isn't trading COMEX contracts. They're financing the factory. You do the same at your scale. Every ounce of physical silver you hold is an ounce that JP Morgan wishes they could control. You're effectively front-running the bank that's front-running the world. Now here's the detail that connects all of this directly to you. Korea Zinc, the company the Pentagon chose, isn't just some random refiner. They're a primary supplier of silver blanks and bullion products to major private mints worldwide, including Scottsdale Mint. When you buy physical silver from reputable sources, you're buying from the same supply chain the U.S. military is now desperate to secure. That bar in your hand isn't just a collectible. It's military-grade strategic material. The same molecules the Department of Defense is spending billions to control. This validates both the quality and the strategic importance of the physical product. As this smelter comes online and supply tightens, the premium on high-purity metal from established refiners is going to explode. The mints, with relationships to these strategic suppliers, will be the only ones with inventory. Everyone else will be waiting in line behind the Pentagon's missile orders. So this is the message for January 2026. The window is closing. The government has officially entered the market as a whale buyer. When governments buy strategic resources, price sensitivity disappears. They print whatever fiat currency is necessary to secure supply. This puts a permanent floor under the silver market and a crumbling ceiling over the dollar. The Shanghai breakout to $82 is the warning shot. The $7.4 billion smelter is the declaration of war. The $38 trillion debt is the fuse. The foreign selling is the countdown. We're entering a period where return on capital matters less than return of capital. The paper system is fracturing. The debt is unpayable. The derivatives are toxic. The only safe harbor is physical assets with no counterparty risk. Do not let volatility shake you out. When they smash the paper price next week to defend the illusion of control, remember what the Pentagon did in December. Remember that while the price on your screen went down, the government spent billions to ensure they have supply. If they're not selling, why should you? The shortage is real. The panic is documented. The squeeze is mathematical. You're not speculating on price. You're positioning for the collapse of the pricing system itself. Watch their hands, not their mouths. The Treasury Secretary will tell you everything is fine. The Federal Reserve will tell you inflation is transitory. The bank analysts will tell you silver is overvalued. Ignore every word. The Pentagon just bought 40% of a smelter. JP Morgan just financed the pivot to physical. China just banned exports. Foreign central banks just accelerated their exit. Those are actions. Those are receipts. Those are the only signals that matter. The convergence is here. December 2025 was the month both crises went from theory to action, and you have 36 months maximum before they expect the breaking point. Position accordingly.